Hi everyone, welcome back to Beerish Podcast. So, as I said in yesterday's video, I bought two companies which I have analyzed, and the company is Autodesk and Adobe. So, as a video editor, I use Premiere Pro, Photoshop, and After Effects. So, the company called Adobe was providing that software, and I come from engineering background. So, in college, we used to have that thing called CAD software in which we draw circuit drawings and all. So this company provide the software services. So I have few things which I have analyzed in these two companies.
First of all, I didn't talk about foreign companies.
Okay.
Right? I wanted you to investigate Indian companies. You are looking at thinking of investing.
Okay.
Right? You're not going to be buying Adobe. You're not going to be buying Autodesk. So next time around, bring me one Indian company which you are interested in. Study about that company and come back with the information on that company. Then we will discuss.
Okay.
So today, anyway, this video since you bought, we will discuss this.
Yes, sir.
Right, will be of some interest for people in just general knowledge. But for your audience, I think, who a majority of them are learners like you, they would prefer an Indian company because majority of the audience are local.
Yeah.
So an Indian company would be something they can follow along and understand and dive into.
Okay. When analyzing this company, a term called EPS and diluted EPS is there. So what is diluted EPS?
So diluted EPS is, it takes into account of any future shares that may be coming into the company through convertible bonds or stock split or bonus. Some way new amounts of shares may reach.
Okay.
So it takes that into account and they dilute the EPS. While EPS is the current stocks which are there. EPS stands for earnings per share. So it takes the complete net income divided by the total outstanding shares of the company, and that gives you the EPS.
Okay.
In diluted, you say, okay, some more shares may be coming, so you take that into account and dilute it. So EPS is what you have to look at. Diluted EPS and all that is of no importance as a value investor.
And looking at the current ratio of both the companies, the current ratio of Adobe is 1.16 and for Autodesk it is 0.69. So since current ratio means current assets divided by current liabilities, does that mean Autodesk have more liabilities than assets?
Makes sense, no? Because you're dividing assets by liabilities. So if it's less than 1, that means you have more liabilities than assets. If it's more than 1, that means the assets are bigger than the liabilities. But then again, I would not really look into that as an important indicator for valuation of a company. The reason why I'm curious to know why you're looking at diluted EPS, why you're looking at current ratio, what else have you looked at?
PBE, price to book.
Book value is price to book is the only thing we look at, and we look at PE and we look at debt.
PE is on the other
so
side.
These are the only important things first you should be looking at. This is why I said bring a company, because what you're doing is getting completely distracted, right?
Yeah.
Diluted EPS doesn't matter. Current ratio doesn't matter, right? Because what our first filter is are these three. First, do you understand the business these companies are doing? Adobe, you understand the business because you're using the software.
Yeah.
So you see everybody using Adobe. So you like Adobe. So you understand the business.
Yeah.
Same way the Autodesk. You've used their software and you know everyone's using Autodesk. So you know the company.
Yeah.
Then what you should look at is the debt. Amount of debt this company has. Did you look at that?
Debt to equity ratio for Adobe it is 0.
No. What is the debt? Does it have debt? Yes or no is the question.
I looked at only debt to equity ratio.
There's another ratio. Why are you looking at ratios? I didn't ask you to look at ratios.
Okay.
See, this is what I mean. Again, you're complicating it for yourself. Okay. Yeah, you looked at ratio, but how do you know if the ratio is good or bad?
It's 0.38 for Adobe and for Autodesk it is 1.16.
So what does that mean? Okay, let's go back to current ratio. Current ratio, you said Adobe has less liabilities compared to Autodesk.
Yeah.
So what are these liabilities of Autodesk?
Deep.
Exactly. So again, you're getting yourself sidelined. You're trying to analyze something which you don't know to analyze, right? You're just pulling numbers out and you're looking at these numbers saying, okay. And this is what happens to a lot of new investors who are watching. What they'll do is they'll go to Screener, they'll go here and there, they'll see these ratios. Then they'll say, okay, this ratio is above 1, it means it's good.
Okay.
We don't know, because then you should really see what are the liabilities, current liabilities. That means within 1 year, their assets which the company is considering an asset for the 1 calendar year, whatever the time period is. Same way with current liabilities. You have short term and long term, right? So you have to really get into that and see. But before that, I just wanted to see if there's debt right? We want to try and look at companies which have very little debt. And Autodesk is a software company. Why should it have debt? That is just something you should think of.
Okay.
What is the business he's doing? He's created a software and he's selling that software for license. Correct? That's his business, right? Is he doing anything else?
No.
I don't know. I'm asking you. Is he doing anything else?
There are other income in the balance sheet.
Yes. Yes, but what is Autodesk's main business?
Providing software.
They created a software, CAD software, and they sell the license to everybody. So why do they need to borrow money? He's not building factories. Is he building factories? Is he making some hardware?
No.
No, right? So the basic thing is this. So why is he piling on debt? That's something to look at.
Okay.
I'm not looked at it. I'm just talking because of the numbers you've given. Same way with Adobe. Right? And the biggest problem for Adobe and Autodesk is in the current software environment with AI and everything, Adobe's main thing is image editing and video editing, right? The way image editing is going, things are becoming free, things are becoming AI driven. Is Adobe able to compete? It's something you have to think about.
They come up with Adobe Firefly.
Yeah, but you like Adobe, so you will have a bias.
Okay.
So that's why you need to see what are the true competition to Adobe. Right? Then you should be able to tell me these are the competitions to Adobe.
Okay.
As a value investor, that's the way you should take. One, does he have debt? Then second, what is the business model? Is it sustainable for 10 years? Or is he going to suffer like Kodak? Is he going to suffer like Polaroid? Is he going to suffer like Nokia? Is he going to suffer like BlackBerry? Is he going to suffer like Palm? Right, 10 years time, will Adobe still be a software company which is relevant?
Understood.
Understood?
Yes.
Autodesk, 10 years from now, will CAD will be a software which is used, or does he have an action plan towards AI being there? Because AI is going to disrupt Autodesk too. I won't need to do Autodesk the level of Autodesking I need to do if AI starts stepping into. So is Autodesk creating its own AI platform, which is going to be built into Autodesk, which makes engineering, drawing, and designing easier. I don't know. Do research. These are the ways you need to think about this. Okay, looking at current ratio, current debt, and all this, it's like I'm looking like a trader. Something I want to hold for a little while and see. So I want you to analyze the company differently.
From tomorrow, I'll do it better.
Yeah, there's no mistake in this. We're all learning. So now you're learned. So what you first pick is pick one company. Don't need to bring two companies to compare and contrast. Right? You pick one company you want to see. Then see that company if it has any debt. Has debt, no problem. If it has debt, is it a small cap? Adobe and Autodesk are not small cap. They have massive cap. So you look at debt. So sir, this company, SKM Eggs, I'm looking at. So everyone's asked about SKM Eggs. I looked at this company. Small cap company, sir, but it has debt.
Okay.
What is it doing for the debt? We'll analyze. Together we'll analyze. Right? But if it's a large cap and has like Vedanta and has a lot of debt, then it's a problem.
Okay.
I'll say avoid it. Right? So you have to value the debt and see.
Sir.
So we'll do that. Second thing is, then you look at price to earnings. What I want you to do is, what's the current price to earnings? Then you can go to Screener and look for 10 years.
5 year, 3 year also, can I look?
Don't know. We're value investors. Minimum we want to hold for 5 years.
Okay.
So you look for 5 years to 10 years.
Yes, sir.
At least I hope the companies you pick are being there around for 5 years. Do not pick a company which did IPO 3 years back.
No.
Okay? Come back and say, sir, they just did the IPO.
Yes, sir.
They're a distillery company. They did IPO just 6 months back. That's no use. I don't want to touch those. So go back to companies which have 5 years to 10 years. Take the current PE. Take the average median PE for 5 years, 10 years. Bring those two numbers.
Okay.
Right? Then we will analyze.
Yes, sir.
Right? You're looking at the current price. You're looking at the PE. Then viewers will also be able to do basic first level, basic level analysis. Debt is there. Okay, debt is there. What companies? It's with debt, small cap, large cap, medium cap. Okay, it's a small cap, as little debt. Okay. 5 years, we're looking at mean PE. It's around 22, sir. But today it's trading at 18. Okay, then why is it trading at 18? What's interesting? Let's see.
Okay.
Look at shareholding pattern. Then we get into the next level of analysis. This, the way you're doing, is just shooting. You're blindly shooting inside a pond trying to shoot a fish. Right? This is analysis we can come later. Once you have done all this basic analysis, you're able to understand. Then you can get into deeper level analysis. Current ratio.
Yes, sir.
But you don't even need to get into that. Because for the simple reason I'm saying basic analysis is great starting point and end point. Is let's say you take a company like what I'm talking about, Natco. Okay.
We discussed that in a video.
It has hardly any debt. Correct?
Yes.
It has median PE you see. It's at
25.
Yeah. And it's trading at 18. It's fabulous. You don't need to worry about current ratio. You don't need to worry about whatever other things you've been looking at.
I just complicated myself in this video.
Yeah, so that's what I'm saying.
Yeah.
So after you do that, then what will happen, Arun? You will start looking at the chart, right? You'll be like, wait, this is an interesting company. Let me see the PE. Then you'll come back to me saying, sir, I spotted this interesting company. This is how you find these rare companies which nobody else is investing in, which you can look at investing in.
Okay.
Then I'll tell you the other problems you can have at that point of time.
Okay.
Okay, you might have found something which is cheap and it has a historic average high, and you'll see for the last 3 years it's been trading very low, and you'll think this is fabulous. Then when you bring it to me, I'll say, what is the problem?
There will be another problem.
Yes, I will tell you at that point of time. Yes. What is the problem? Because if I tell you what the problem is now, you will start filtering everything. So I want you to first learn filtering based on these simple metrics, Anand's metrics. Then we will dive into deeper analysis once we have a list.
Yes, sir.
But you pick one company, right?
Understood.
Then let's analyze it like that. This kind of analysis is great for video, but you're not going to learn anything from this.
For beginners, it is beyond their reach.
Because you yourself do not know what you're telling me.
Yes, sir.
Correct.
I just found the numbers from the website and wrote.
Yeah, and you did a bit of Googling here and there, and you're asking me, okay, I can answer it, but we don't learn anything. We're a learning podcast.
Yes, sir.
We're not discussing in-depth expert podcast. Right? So do this and come next. Then we will discuss greater in depth.
Okay.
But since you brought this, if I had to put money, I would not invest in both these companies as it is right now.
And P is very expensive. 49 for Adobe and above 50 for Autodesk.
Correct. That itself I won't go near doing any more analysis. Because if I look at these two, they might be whatever you say. But looking at this, it's too expensive.
Yeah.
And like I said, if you look at the industry the way it is, there's so much of uncertainty over the next 10 years.
Particularly in the creative field.
Correct. And I'm looking at buying a company and cruising at growth of 10% to 11% compounding and an average for 10 years and sitting pretty.
Yes, sir.
These companies are not going to do this for me.
Okay. Just curious to know the softwares I am using, good to analyze.
No, you're doing two wrong things. It's a great software. No doubt about it. You're using it. Fabulous. But immediately when you see the PE, you know there's nothing to talk about it.
Okay.
If you had bought this and you said the PE was 19, then we'll have to seriously think about it. We'll have to do further analysis and say why a great company like Adobe is trading at such a low when the markets are such a high.
Yeah.
Like what we do in Natco. We wonder, everyone wonders if
the
everything.
Sector
is doing very well. Dr. Reddy is doing very well. Everyone's doing very well. Why Natco alone? Everyone wonders that.
Yes, sir.
Sometimes Mr. Market is like that. Okay. But
so today's video was great learning to me. You shouldn't be biased towards a particular stock.
Correct. And you're doing the fundamental mistake of you're picking these stocks when the PE, the third thing you've written is PE. First you wrote
market price.
Market price.
Cap.
Yeah, you've written. Okay. First of all, we're not going to be buying these companies. Fine, $51. Where are you going to spend 50,000 rupees buying one share? But as soon as they hit PE, you should have been like, okay. Understood?
Yes, sir.
Chalo.
So I hope that this video was informative and you had some knowledge about how to pick the stocks. So today, my biggest learning was not to get biased towards a particular stock. So even if you use that particular product, if it doesn't have good numbers, there should be no bias to investing in that stock. So if you found this video useful, please share it with your friends whom you think this video will be helpful for them. So please like this video, share and subscribe to this channel for more videos. See you in another episode with an interesting topic. Thanks for watching the video.
Thank you.